Welcome to the Finimize podcast. I'm Carl Hazley. Blue Whale Growth Fund has over $1 billion in assets under management and invests in 25 to 35 companies that it believes are high quality and will outperform the market. I sat down with its managing director and chief investment officer, Stephen Yu, and put some tough questions to him about the firm's high conviction approach and why so many active managers underperform the benchmark. We also talked about his investment process and how his firm spotted the opportunity in Nvidia before almost anyone else did. But before we jump in, if you want to stay ahead of the markets with quick, sharp updates, then tune in to the Finimize Daily Brief. It's the perfect companion to this podcast. Every morning, we dive into the two biggest financial news stories of the day. Plus, you'll get regular questions answered by yours truly, unpacking the key questions you have about markets. You'll find a link to the show in this episode's description, or just search the Finimize Daily Brief wherever you get your podcasts. Now, on to my conversation with Stephen. Stephen, welcome to the Finimize podcast. Now, I'd love to start with your investment approach. Tell me how you at Blue Whale pick stocks.
So our investment philosophy is very simple, that we aim to invest into high quality businesses and attractive valuation. And the way that we approach the market is to try to invest into the best of between 25 to 35 companies globally. And we do all the research in-house. So there's a lot of things that we do behind the scene to pick those companies. But that is simply what we do.
Okay, and maybe get from the thousands of companies out there to the 25, 35 in your portfolio. Can you maybe give me a flavor of the process? How do you screen? What is it you're looking for? How do you start to break down such a big challenge?
Yeah, that's a very good question. So we do not use any quantitative screening. And if you use the MSCI World Index as a proxy for the world stock market, there's about 1,500 stocks. Yep. And over the course of the last 7 years, or including my previous experience working in other strategy as well, that we probably have done work on over a few hundred companies. But of course, what we do is we have a very high hurdle for the quality of the businesses. So you can imagine that part of the stock market, there are many indebted companies, low quality businesses, or companies in certain sectors that are highly competitive with very low margin or unprofitable businesses. Like we naturally would exclude them because they would be considered as low quality companies. So on a very high level, that we don't have to cover the world, 1,500 stocks, is like we just need to cover enough that we would be able to make a decision to find companies that are not only high quality, but at the same time can do very well for our investors.
Fantastic. And you've said high quality a couple of times. We're going to get into some of the stocks in your portfolio. Now, probably the most popular stock in the world right now is Nvidia, and it's one of your positions. It's one of your top 10 positions. It's, like I said, one of the most popular stocks in the world right now. Everyone's talking about it. So maybe on the one hand, it's quite easy to understand why. But I'd love to spend a bit of time trying to understand, why you've been on the record saying this is a stock every investor should own. What is it that gives you confidence in the long-term opportunity here beyond, this is AI, everyone's talking about it. How do you think about that?
Yeah, so I need to cut my answer short here. Otherwise, I could spend the next half an hour just talking about one single stock, Nvidia, which is very exciting, and we have done really well on the back of that. But the interesting story about Nvidia is while the fund strategy started back in late 2017, we only started investing into Nvidia in the middle of 2021. And if people recall what happened in 2022, the share price went down by over 50%, and Nvidia's market cap trough at around $300 billion in October 2022. Right. What we did at the time was we took the opportunity to increase our position significantly. And so by the time Nvidia's market cap surpassed $1 trillion in June last year in 2023, we already were holding like a 10% position, which is the maximum that we can hold in that shares. And we have maintained a 10% position in Nvidia over the course of the last 12 months, which now Nvidia is currently trading at over $3 trillion. So we have made a lot of money from Nvidia, and we have actually sold more shares than we currently own just because we
Wow.
have a 10% limit on that shares. But I think on a very high level, of course, one thing investors need to remember is the level return that Nvidia has delivered for us as shareholders would not be repeated in the similar level trajectory, right? If you think Nvidia has gone up 200%, it's unlikely that it can do that in the next 2 years because mathematically, Nvidia could easily become a $10 trillion company in no
Yeah.
time. So I think the expectation need to be tailored, but we do expect Nvidia to continue to do better than the market, which is the objective of the fund, that is to outperform the market with better performance. So we would think Nvidia can still do a lot better than most of other companies in the market. And there are two things to it. So firstly, we are a true believer in how generative AI is going to change the world. We think we can debate on the timing, we can debate on how many years it's going to take, or which company are going to come up with a game-changing application, etc. But in terms of the AI infrastructure, which NVIDIA is leading, that everyone would need to invest into the AI infrastructure, which is the computing power, before you can have a chance to develop some sort of AI applications, which would include companies like Microsoft, Google, Amazon, or even Tesla, some others. But it's not a guarantee that while you have spent the money in investing into AI, you would come up with a usable AI application that everyone want to pay for. So firstly, NVIDIA is in such a strong positioning with the CUDA software ecosystem that everyone would need to join the ecosystem in order to come up with that. And then secondly, just because the market is in a very nascent stage, that every company is spending money. And if you look at the numbers, it's actually not a lot, but NVIDIA is making over $150 billion of revenue this year compared to about $30 billion 2 years ago. And who is spending all this money are all the biggest company in the world, like the Google, the Amazon, the Facebook, Meta, Tesla, and others. So, and we haven't actually seen the massive spending from enterprises like HSBC, Unilever, GSK, like any other big company would be also equally using NVIDIA GPU to increase their offering, etc. So we think we are at a very early innings of that journey, and NVIDIA would give you the best chance if you do believe in how generative AI is going to change the world in the near future.
That's really interesting. You said at the beginning, we could spend an entire podcast just on NVIDIA. And I'd love to dive into, why in 2021, when the stock was down 80%, what gave you the conviction that now was the time to buy in? But maybe we'll come back to that another day. I'd like to take a second to spend some time on the other side of the coin, because you talked about, winding down some of that NVIDIA position, selling profits so that you're in a 10% position. You talked about some of the other players in that ecosystem, and maybe there's a bit of give and take. And I guess what I'm driving at here is Microsoft, which, when you started the fund, Microsoft was one of your top 10 positions. It's one that's become a smaller and smaller position. And, you recently shifted your view on Microsoft. And is that a bet that actually Microsoft's AI spending won't pay off? Is that one of the bets you're implicitly making there, or is it simply a profit-taking exercise? Is it a valuation play or call? How should we think about, Microsoft and NVIDIA tend to go hand in hand when investors think about the AI opportunity. So why one and not the other?
Yeah, this is a very important and interesting question, because there's a massive differentiation between AI infrastructure versus AI applications. And of course, in today's narrative, if you speak to the bullish people, investors in AI, they probably talk about the two things together. If you speak to people who doesn't believe in AI, they will be referring to the likes of Microsoft overspending, investing money into AI while they couldn't see the return on investment, etc. So for us, we actually see a massive differentiation between the two. And we do share the argument that the return on investment by Microsoft spending, Google spending on a Gemini, and some other company going to spend a lot of money on this, is going to come down. It's not going to be on the same level. So what it means is, while Microsoft, which we like, we still have a position which is a lot smaller now, that is going to make more money on the bottom line basis. But the return on invested capital, which is a metric that we use to define whether a company is high quality or not, is coming down as we speak. Because if you think about the $30 a month that Microsoft used to charge us for Office 365 subscription, they probably make 80% of that margin. And then the other 20% would probably be on some cloud storage that we have, the OneDrive, your email inboxes, and the Teams recording, etc. Right? But when you think about the co-pilots that Microsoft have launched, Office 365 co-pilots, which they equally charge us about $30 a month per user, they do not make the similar margin, because a lot of that money is being paid to either Nvidia GPU or their own in-house GPU in time. So, but the issue with that is, like, you cannot not pay money for the computing power or the training of the models, which is a continuous evolvement or improvement in terms of whatever the information we are giving to the AI to learn about. So it forever would change the business model of all the big tech companies. And of course, I mean, they are here to stay. No one else has the money to spend on all this GPU. So they are here to stay. But then the quality of Microsoft is going to come down from here compared to when we first invested 7 years ago. So the last point I would make, which I think you already pointed out, that Microsoft has been a consistent top 10 holding in the fund since September 17 until August this year. So it only dropped out from our top 10 in September as we speak. Yeah. And we have been selling Microsoft over the last 6 months. And now we have an underweight position in Microsoft. So we still like Microsoft as a company, because ultimately it's a relative game in a way that would you rather to have Microsoft than Unilever. We would rather have Microsoft because it still can outperform. But then Microsoft is a very different company now compared to when we first invested back in 17. Microsoft market cap was at only about $500 billion. Yeah. So now it's over $3 trillion. It's a very different company. And then so the level of outperformance that you can expect from Microsoft from here will be a lot lower than what it used to be. So if we can find better alternative, which we have some other names like Oracle and some like Meta, we think Meta is going to give us the highest return on investment in terms of the spending in AI, then we would have a bigger position in those companies.
Got you. So you made an interesting point there about, I guess, relative returns or relative upside. Like, would you rather own Microsoft or Unilever or Microsoft or Oracle? And, you know, from our conversation so far, you'd be forgiven for thinking Blue Whale is a pure play tech fund. But that isn't necessarily the case, is it? Because one of your bigger positions is in Philip Morris, consumer staples, and you don't often associate consumer staples with growth. So would you rather own Microsoft than Philip Morris? Maybe your answer is Philip Morris in this instance. So again, can you maybe just spend a bit of time on explaining, you know, the thesis there, why a relatively stable consumer staple has made it into the top 10 of your holdings?
So I will come back to Philip Morris in a second, but I think one point I feel is really important after having run the strategy for 7 years now is there's this misconception in the market to label our strategy being a technology fund. Yeah. And if I look back over the last 7 years, I think on average, we probably have about 40% of the fund in technology, which is relatively high compared to some other global funds or maybe our direct competitors. And because we have done exceptionally well from our technology holdings, the first 4 years was related to digital transformations, opportunity like e-commerce, digital payments, advertising, cloud software. And then now recently it's all about artificial intelligence. And then people obviously want to talk about AI or technology. And then we got being labeled as a technology fund. But if you ask me personally, I do not really care about technology. I care about technology holdings as long as they can help us to outperform the market, which is the biggest problem that we're facing as an active manager, that most other active funds are underperforming the market. And they are blaming that, oh yeah, we don't own the tech, we don't own Nvidia, that's why we're underperforming. I think that is an excuse. Like, there's no reason why you should have like a lot of your exposure to consumer staples if you do not believe consumer staples is going to do a lot better than technology. So it's a choice. But in time, of course, the market will move on. Maybe we do not want more technological advancement. Maybe we want to slow down the adoption of AI. And in time, you could expect us to have a much lower exposure to technology. So going back to Philip Morris, which is a very interesting name, of course, we like companies that are going to give us a bit of idiosyncratic driver, right? Like if we can do well too, irrespective of whether it's AI or not, like we would like the company. So what Philip Morris is doing is they are probably the pioneer to make the so to create a world for smokers that is healthier. So they have acquired Swedish Match about 2 years ago. And as you might know, Swedish Match offers products such as chewing tobaccos, nicotine pouches. And then Philip Morris, they have pioneered the IQOS gadget, which is heat not burn tobacco cigarettes. And so if you look at the business now, 50% of the business is in non-traditional cigarettes. So the direction of travel, I think, is a bit of a transition that the world would be a bit healthier for smokers who want to consume nicotine, which is a choice. But the other thing why Philip Morris has done quite well is because when they split out from Altria in the US many years ago, Philip Morris is all about the world, the rest of the world outside the US. But what has happened was that because they developed this very interesting technology, IQOS, I quit ordinary smoking, that's what it stands for. Oh, cool. They got the approval to sell the product in the US. So they are now going into the biggest market in the world, and they never have exposure to the US market. So this is like a huge opportunity of huge growth runway, and there's little competition in the US. And obviously Swedish Match was already in the US doing quite well. So when you put all this together, you might think like, oh yeah, Philip Morris is such a boring company. But if you look at the year-to-date performance, it's gone up about 30%. Yeah. So, and even I think Microsoft probably have gone up similar. Yeah. And so if you compare the two, like I think I would want to have both.
I guess the question is, where are Philip Morris's AI chips? Where are they hiding them?
Yeah. So obviously, I mean, ultimately, we want to have every single stock like Nvidia, but that's not possible, isn't it? Like, there's only one Nvidia, and then the fund we need to have like a minimum of 25 stocks, so we can have other opportunities. That's a bit idiosyncratic. This is like not a single bet kind of strategy, right? So we have AI, we have Philip Morris, we have some luxury, we have Visa, and some other names. So I think that's what we like them. But ultimately, the one thing I want to just reiterate is the common connector among all our holdings is quality.
Yeah, I mean,
so they're all high quality businesses, and then we think they can outperform. That's why we have these companies.
I mean, one way when I looked at the top 10 holdings, what jumped out to me is they were all sort of monopoly or oligopoly type businesses, very high barriers to entry, very high sticky, high switching cost, network effect type businesses. And so I'd have argued if I knew nothing about the fund and I just saw that list of holdings, I wouldn't necessarily have gone tech or growth. I'd have gone, well, this is, defensive, counter-cyclical, with a bit of growth in there, but more because AI is happening rather than because you're chasing growth. But again,
but this is also a very interesting point because obviously, I mean, we have been reflecting on our 7-year journey, and I remember that during the pandemic that we got lumped into other growthy strategy that basically were investing into companies that are unprofitable and growing their market share. Of course, when we went into 2022, we lost money in the first 6 months of that year. So did other funds that are very growthy. And then people say, yeah, it's all expected that you guys would lose money or underperform because you have a growth bias. But what have happened since then, like since July 2022 until now for the last 2 years, is we have recovered very, very strongly. And we are now back above our high water mark. But if you look at other strategy, which have a growthy label, they are still about 40 to 60% below the high water mark. If you look at Cathy Wood's strategy, I mean, you know what I'm talking about, right?
Yeah,
So
knives
then
out.
if you ask me to say, okay, so what have happened then? Like, why have you guys managed to do so much better in terms of recovery? It's because of quality. Because as you already outlined, that the company, even though Microsoft have gone down just about 30% in 2022. We know that Microsoft is highly profitable. The business model is so defendable. And they're going to make the money back. And I mean, to us, it's like a valuation reset. It's a great opportunity to buy more of Microsoft at that time in 2022, and hence the recovery. So I think quality, we could change the name of the fund to Blue Whale Quality Fund rather than Blue Whale Growth Fund. Maybe that's better.
I think Cathy Wood obviously isn't on this episode with us, but just in the interest of balance, I reckon if she was here, she'd say something along the lines of, if you strip out Nvidia from October 2022 to now, maybe that's the part, at least a large part of the delta. But either way, you managed to pick the stock, so props for that. I'd love to switch gears a little bit, because around the world, and even as we record, stock markets are hitting record high after record high. We've had Fed rate cuts. We've got, India is one market where just across the ticker tape, I think we're 6 days in a row, record highs. Yes, there have been some notable bumps along the way. Thanks, Japan. But I guess my question to you about in this environment, do you feel comfortable as an investor? Do you prefer, does this feel like irrational exuberance? Or, do you prefer investing in, 2022 when markets were tougher? What sort of environment do you prefer? How do you feel about markets right now?
Yeah, to us, I mean, we only need to pick about 25 companies. So probably our job is a bit easier, that we don't look at the world per se. I mean, we try to find the best 25 companies. We can ignore certain markets just because we don't need to follow them as much as maybe some other people do. But I think one thing I would say is I do find that the current market environment is very challenging. It's being increasingly challenging to find not only high quality businesses, but high quality businesses that can do well in this new environment. Right. The exception would be the names that we just talked about, but then the opportunity set have shrunk for us. Like the good old days when we first started back in 17, I think it was a lot easier to find names that are exposed to digital transformations. Most of those names are consumer facing, right?
So lower as well, right?
Yep. But I think in today's environment, without going into too much in macro, like we have increase in geopolitical uncertainties, oil price is still at a very high level, reshoring activities, which is very inflationary, and then interest rates going to stay at a high level than before. I look at the 5-year average interest rate in the US until 2029 is still going to be more than 3%. So if you look at the 30-year mortgage rate in the US, it's still going to be above 6%. So there's a lot of implications on consumer discretionary spending. If you think about the developed market, which 2/3 of GDP is coming from consumer spending, and then you follow the stock market, and I would imagine that about 2/3 of those companies would be consumer facing, okay, not just purely discretionary, maybe there's some recurring consumer staples, etc. But then it's a lot difficult to find company. And hence, if you look at luxury brands, like you would think like, oh yeah, the world has just recovered, the stock market all-time high, surely everyone's spending money on luxury. It's not the case. I mean, the shares has gone the other way because of some concerns on spending. So actually to us, it's a very difficult environment, and hence we are very comfortable with our holdings. We think like over the cycle of, let's say, 3 to 5 years, they would do very well. But we are not that positive about the market per se. So if you ask me do I like the US market? I don't really like the US market. Do I like Nvidia? Yes, I do love Nvidia, okay. or Meta or Oracle.
I guess that brings me to sort of another question, which is around active management in general. And you made the point that most active managers have been underperforming the market, right? And I guess there's maybe some technical reasons around that, around concentration, and maybe that might reverse over time and be a bit of a tailwind. But I'm curious, just let's just lay it out there. Why are so many active managers underperforming, do you think?
I probably can't speak for other active managers, but this is not a new trend. That's why the rise of the passive is getting stronger and stronger, and we do feel that pressure in terms of people giving us money, because they would probably rather to give it to the passive rather than doing some work about which active funds is going to give me better return.
Yeah.
In this journey, I'm sure your audience would feel the same too. It's easier to buy the S&P/X or NDX, QQQ and all that, rather than say, okay, maybe I need to do some work on Blue Whale.
Yeah.
So we do feel the pressure from a sort of capital allocation point of view. But what I would say though is I think the industry have lost focus in terms of why are we here? Why are you paying us an active fee to do what we are doing? Like, the only reason that we are here from a Blue Whale perspective is to be able to give you better return than any other alternative. Whether the alternative are our peer group, other global funds, or the market, which would be the equivalent index tracker. And the entire process of Blue Whale, including the investment philosophy, is built around that. Like, the reason that we do all the research in-house, not to speak to sell-side analysts, not to read brokers' research, having a quality bias, because then we can recover very strongly, is all to do with delivering that significant outperformance. And if we cannot do that, I'm not sure why people should be interested how we are going about things, right? Like, if you're not even outperforming, I don't want to know like how you have done your training, like how you have all this discipline, the morning discipline and reading annual report. I don't want to know, because like, you're not doing your job right. So what I think have happened is there's probably quite a lot of active manager has been overly believe into that investment philosophy. They would probably think like, this investment philosophy worked for me in my first 10 years of my career, and it should continue to work in the next 10 years of my career, or forever. Like, there's nothing like that, right? Like the world evolved, the AI or the market become efficient very much. I mean, if you ask me 20 years ago, more than 20 years ago, when I started my career, you can use sell-side research to generate alpha. But with MiFID 2 and all that, with all the information being online, like with Finimize, educating your audience base as much as you're doing now compared to 20 years ago, the market is a lot more efficient and the world have changed. So if you are still thinking about, I'm going to have face-to-face meeting with company to add some value, no one is going to tell you anything today, because they're worried that they might be going to the jail. They get reported to break the rules. So the market changed, and I think very importantly, from an active investor or manager perspective, is that we need to evolve our process with times. So then going back to the point about consumer staples, it's like, yes, they have done really well, maybe the 10 years before the last 7 years when we started. But you cannot just keep holding on that. Like, they're a fine company. They're not going to disappear. We're still going to have Unilever, some product, but they're getting smaller and smaller. So then maybe they're never coming back. Maybe they're going to be a small part of the market and they can't help you to outperform. Then why are you still in love with consumer staples per se, with the exception of Philip Morris, of course?
Yeah, of course. Okay, so I have two immediate follow-up questions. So the first one, you have to indulge me, because in a past life, I was a sell-side research analyst. And you not speaking to the sell side is really intriguing. I know a few funds that don't, and I guess my question is that a fundamental process decision, or is that look, we're under pressure as an industry on the active side from the passive. One way to keep costs down is to not engage the sell side. Like, how have you landed at this position?
So it's the former, not the latter. So the reason for the former is nothing about the ability of the sell-side analyst. So if you are still the sell-side analyst, we would love to have you working with us to do the research, right? The issue that I have with sell-side research or sell-side analysts, not the analyst per se, but the research, is because it's readily available to everyone.
So there's no
all our competitors would have the same piece of research from Goldman Sachs, Morgan Stanley, UBS. Yeah. And then so if you are reading the same research produced by some sell-side analysts, how are we able to make a differentiated decision that is going to be very right, and no one else is seeing things. Like, it's impossible, right? You read the FT together, it's very likely that you have formulated a very similar conclusion.
Yeah.
And the other thing about sell-side research, nothing to do with sell-side analysts, is because the research in itself is very generic in a way that it cater for different style of investors. Like, that you would have value investor reading the research, you would have us with a quality focus reading the same research. And then you also have hedge funds that might have a shorter time horizon reading the research. So then the research in itself is not tailored to your own investment philosophy with the time horizon. So then, to me, it's not usable, because like I can read the research, but it's like I'm reading the FT. Like, it's not telling me anything that my competitors doesn't know. But for us, because we do all the research in-house, like everything is tailored to the way that we invest, how we operate on a daily basis, how we follow quarterly earnings, how we then can take a view in terms of the timeline, how much time we would give the company. So everything is tailored together. So that is what I think is very important in today's world, being a very competitive world, and being the market being very efficient, that if you're not doing something more original, you have a lesser chance to outperform the market. Because like, for you to formulate a differentiated angle based on external research, that is very difficult to do. And then if you've ended up with the same conclusion with everyone else, then there's no outperformance to speak of.
Yes. Okay. Got you. The second question that jumped out is just, I guess, how you think about diversification or portfolio strategy. You know, you made the point earlier that Blue Whale exists to give you the best performance possible, whether that's versus competitors or versus the market. Now, you know, you're on record. You say that you only invest in Blue Whale with your own capital. Now, is that only from a fund perspective, or basically, I'd love to understand how you think about diversification, you know, within the asset class of stocks, but also multi-asset, and whether, you know, I guess there's a natural tension between diversification and high conviction. The fund is high conviction on 25 to 35 names. And then how you think about diversification, I guess, also in the context of, you know, the active peer group, because a ton of people are underperforming, partly because their strategies are tailored to be the diversifier that offsets, you know, owning US stocks and therefore owning European value or whatever it is hasn't worked, and so on. So yeah, I'd just love to understand how you think about that.
Yeah, so on a very high level, that for me personally, obviously I'm biased, right? I'm running the fund, so I have an inside track of what's going on, and I can make decision accordingly. Yeah. So for me personally, outside of my property or cash investment, all my investment is into the Blue Whale Growth Fund. I don't invest in other funds. I don't hold any stocks, etc. So that is for me, because I would feel very comfortable in terms of what I know I have owned, rather than I rely on another manager. But of course, I can't say that for your audience, because you don't have an inside track of what's going on. But what I would say, though, in terms of diversification, is that, I mean, if you look at any studies, that they would probably have shown you that anything that's above at least, 50 to 100 stocks is too much already, right? Like, you would have achieved enough diversification. But of course, I mean, it's not like 50 to 100 stocks in the UK, right? You probably have maybe a few stocks in the US, few stocks in the UK, few stocks in Asia, in India, in Japan together, right? Like, you get to maybe 50 to 100 stocks. Yeah. But I think what happened in the industry is, like, we have probably too many cross-sec trackers. So we have too many overly diversified funds. And then if you end up owning a few funds that are quite diversified, you would have ended up with a few hundred, if not thousands of stocks in your portfolio easily, right? Yeah. Because like, then I go back in time, 7 years ago, why I decided to launch a high conviction approach is because I felt there's been a shortage of high conviction funds. Because theoretically, if you want diversification, it's better for you to own three similar funds like Blue Whale, but with a very different investment philosophy. We are all high conviction, like we are actually backing our company with everything that we have, right? Like we're not doing anything else. We're just backing that 25 companies. And then you have another manager, maybe with a value mindset, income mindset, or Asia focus, do the same thing. And it's better for you to split your investment across the three funds rather than to buy one fund that will give you 100 holdings or something, and then you are reliant on one single manager. But I think the market have changed now with the rise of passive, that I think everyone would have a decent exposure to passive. But the point that I would make on passive is I think we're still in the middle of the journey. Is passive at the moment is a good way to park your money because most active managers underperform. But in time, if most of the underperforming active managers are no longer running money, and then hopefully we are one of the few last man standing, then you want to have a differentiated return because like everyone else will be getting the same return. Then no one is progressing, is it? Like, is everyone get paid the same bonuses? Like your house is exactly the same value of your neighbor. Like then of course the inflation and the price of goods will reflect that. So you shouldn't be happy if S&P has gone up 10% because all the prices that you go to the coffee shop restaurant would equally gone up 10% and your wages would exactly gone up 10%. And so no one have won. So then I think by the time that when the transition had probably be more completed and more people have moved into passive, they want to have the active to complement. But I think if you have a decent portion in passive, then that's enough diversification, right? Like, so imagine if you have 70% in, I don't know, the world stock market ETF, and then you decided to have, I don't know, 10-20% allocation to Blue Whale. That is enough diversification. Like you would have like a few 100,000 stocks already. So, but then we probably give you the kicker that you can do better, right? Complementing what you have. So I think that's probably where the world is shifting. That I of course, I'm not asking anyone to put all their money with us because you probably would not have the same level of conviction as I do. But then I think there's a role to play for active within the mix of the passive kind of allocation. That's how you get the diversification.
And then I just want to spend a bit of time on communication because you talked about 2022, first 6-7 months being a tough year in terms of performance, and I'm curious about how you engaged with your investors during that time. Obviously when the last couple of years things have been good, performance has been very strong, and that's an easy letter to write. But when things are not working and you're underperforming, how do you have that conversation? What do investors respond best to from a content point of view?
Yeah, so we actually, I would say that we probably have done the most from maybe within our peer group basis, that we have been engaging with investors a lot in 2022. Like we have written a few articles, we have done a few conferences for retail investors, and then we have done a few webinars with different investor base just to explain to them this is not the time to worry, right? Like I was showing a chart on Microsoft earnings power over a long period of time while the share price was down over 30% at one point in 2022. And I kept telling people, like, this is not the time to worry about Microsoft. Microsoft is all fine. Like, this is just a one-off valuation reset on higher interest rate expectations. It has not changed the fundamentals of Microsoft. So I think there's a lot of kind of like hand holding in a way, because obviously we have done the work on Microsoft, our investors probably haven't. So there's a bit of hand holding. But the other thing, which is I thought now looking back, it was something that we have done that I felt quite proud of. Hopefully next time around we can do it again and more people might follow us, is if you recall that in July 2022, that we decided to kick off with a pound cost averaging exercise. This is more for the retail audience, that the company Blue Whale Capital decided to invest just about £120,000 into the Blue Whale Growth Fund. But the way that I decided to do it is I want to use this as a real-time exercise to showcase what investors should be doing while the world is so uncertain, while maybe the fund was down about 30% in the first 6 months of the year, but then you don't know what's going to happen. So rather than put out all your money, which would be, I wouldn't say gambling, but it would be like maybe it's too much, like you put 120K in 1 month. What we did was like we communicated with the market, we're going to put 10K a month for the course of a 12-month period, which ended in August 2023. So if you look at the return that we have generated in that 12 months investment across every month, that the the return has been more than 50%. So out of the 120K, we've made 60K just on the back of that strategy. And I think this is the thing that people need to do. Is in 2022, it was very difficult. People were panicking, everything was going down. But the worst thing to do in such an environment is to sell your investment, which some people did, or to rotate into other things at the wrong time. It's good that you stay put, don't do anything, because like if you believe nothing have changed in your holdings or the investment you make, don't panic. But the best thing to do, which would relate to how much you know about your investment, including the fund that you invest into, for us would be the companies that we're backing, is to put more money in if you can. Then that's how you then can recover so much quicker. That's what we did. Because if you look at the recovery path that the fund have delivered since that drawdown, like we were a lot quicker because we were selling things that have not gone down as much, and then we were buying things that have gone down more for no fundamental reason. So I think that was very important for us. But of course, I mean, it was different parts of the journey that we probably haven't got enough followers to follow us into doing that strategy. But we still have that on our website, that hopefully next time round, if we go through that again, that maybe people would believe us more. Like, don't panic, stay put, and if you have excess capital, then maybe it's a time to do it, but you don't do it in one lump sum. You can spread it out over the course of 6 to 12 months.
Absolutely. That's very good advice. And I thought a very clever process. I want to switch gears a little bit again, because you've had a career over 2 decades long and counting. You've managed money at a number of firms in different environments, different strategies. And I just want to ask a couple of questions from your experience, which is, firstly, what, in your view, makes a good investor?
Yeah, this is a quite very big question, isn't it? Like, so I think obviously to start off with, you would need to have the right technical skill set. So for us, we would consider ourselves being traditional business analyst. So you would need to be able to understand accounting. You will be able to read an annual report. You can follow what the company does in terms of different sectors, or being a generalist, following different sectors. And at the same time, you would need to have the technical skills to build financial model. Just as you mentioned, the sell-side analyst, you would have all the technical skill as a starting point. But then, of course, then what differentiate one investor with the same skill set versus another? I would say, after running money for so long now, is whether you are in sync with what the market is thinking, or how are you positioned relative to what the rest of the world is positioned. Because everything that we do in terms of the process, the research, the financial modeling, trying to make forecasts in terms of valuation, etc., is only going to do one thing. The only thing is to be able to come up with a differentiated view on the outlook of a company that is more likely to be proved correct. Everyone can do research on any company. If we all come out with the same conclusion, there's no outperformance or underperformance to speak of, right? If you just want to be a contrarian to say, oh, Nvidia is a bubble, fine. But then you probably would have underperformed, or you would have lost money if you're shorting Nvidia over the course of the last 12 months. So there's no point just being the sake of being a contrarian. But you would need to be a contrarian in a way that you need to know something that the market doesn't. And then the likelihood of your belief or your view would need to be more right than wrong. So for us, over the course of the last 7 years, we have got more things correct than incorrect. That's how you get the outperformance. Of course, we make mistakes too. So what I would say is, probably going back to why most active managers underperform, I can't speak for them, but I feel like sometimes when I read some certain article, they say, oh, I invest for the long term. I don't do much trading. I would hope to hold this company for the next 5 to 10 years. I don't know how you can do that, because if I look back over the last 7 years, we've been through things that we've never dreamt of before, like the pandemic, QE, inflation going up the roof, the conflicts in Ukraine. It's like a lot of crazy stuff that happened in the last 7 years. How could you come up with a portfolio that could do well irrespective of what's going on in the world? Like, now I'm looking forward to the next 7 years. I don't know what's going to happen, but we would need to reposition the fund accordingly, right? So then we continue to evolve the positioning of the fund subjected to the macro backdrop of where the world is heading. So I think it's getting in sync with the market. That's the most important. That you cannot say, "Oh yeah, I like this company." You need to know what you don't know, and then you need to ask the question like, if you have a differentiated angle, why do you think you know certain things that the market doesn't? Because the market's very smart. On the other hand, and I think it's just that kind of competitiveness, trying to out compete or out kind of research on your holdings versus the market, which is everyone else that you're competing with. That's where the alpha or outperformance come from.
Got you. And then I guess a related question, because you're managing director and CIO at Blue Whale. What makes a good leader?
So we, in terms of the culture at Blue Whale, there are 5 of us, so that the other 4 people working together, and I think the one thing that's very important is you need to hire the right people to start with, because like if they don't have the right skill sets we just talk about, then it doesn't quite work. But if you ended up having the right people in the team, then you would need to probably trust them in terms of their recommendations. And of course, you see their numbers, you see their track records, and you cannot do all the work yourself, right? If my analyst has spent so much time covering this company, I'm not going to go into the financial model and say, okay, what about this? What about that? I would certainly ask those questions, but I probably wouldn't have the time to go through the 10 annual reports in order to find the answer, right? So then I think over time, you need to be able to work with people that you trust, and then they have excel that sort of skill set, at the same time the track record for their recommendations too. So I think putting all together, that is then that's how the Blue Whale Fund comes about, right? Like someone is covering Philip Morris while another person is covering Nvidia, for example. So then how do you put everything together in the fund structure while having all of them passing the quality hurdle, and then we speak the same language, we have a similar time horizon, and then we would be very competitive in a different ways in terms of the different company that you invest into. And so that is probably more of the culture that we set, and the interaction in terms of the feedback, etc. And of course, I mean, if we have made mistakes, which we do, then you need to move on, and we have a way of acknowledging mistakes and having a different way of feeding back, and we hopefully like we can move away from mistake quicker than our competitors, how you outperform too. So you lose less money. There's another way of outperformance or better performance.
And the proof is in the pudding if we look at your track record there. Stephen, there's so much more we can talk about, and I think we need to get you back on the Finimize podcast before too long, or this will have expanded to a 2 or 3 hour session. But before we wrap up, I'd love just for you to share how and where people can find out more about you, your work, and how to invest in Blue Whale Growth Fund.
Thank you for that. So you can come to our website on bluewhale.co.uk. So you can either invest directly on our website, which would give you, I would say, the cheapest way to access a share class, because there's no platform fee to do it. But if you are already a customer of like Hargreaves Lansdown, AJ Bell, Interactive Investors, or some other platform, like we are available on all platforms. So you should be able to find out about the fund on those platforms.
Fantastic. All that's left for me to say, Stephen, is thank you so much for sharing your insights, your views. Really, really interesting. Thanks again for joining the Finimize podcast.